Let's see here. Start seeing live sessions anywhere. Aha, we are live. Okay, perfect. Let me just post this link now. Live session. Okay. All right, guys. It's Sunday, June 14th. My name is Amol. I have Faisal on the call. I have Austin Ashraf. He's a previous portfolio manager from Citigroup. And today we're going to discuss the stock market. And we're also going to discuss some economic development that's happening, specifically in the US. We'll talk about this article right here, which we talked about in the Advantage side, the looming bank collapse, and many other things. And by the end of the video, the Advantage members will also get to see our market positioning. And so that's only for Advantage members. But until then, welcome Faisal, welcome Austin.
Glad to be here.
Great to be here.
Awesome, guys. All right, so heck of a week. Starting I think Thursday or Wednesday when the sell-off started. Austin, I mean, any thoughts like how last week ended? What's going on through your head?
Well, like I mentioned last week, that market was extremely overbought, and so market pulled back last week, and I still think that market is overbought, but not extremely overbought. And so my thought process is that it's going to be a slow grind, but eventually it'll find a bottom and it'll start to grind higher again.
Interesting. Awesome.
It'll take a little while to work off this overbought condition.
Okay. Got it. Good to know. Faisal, your thoughts?
Yeah, last week was one that was very different from all the weeks prior to when we first hit the bottom to, this amazing rally that has happened over the past month and a half. What Thursday really signified, that 1,800 point drop, was that volatility is back in the market in a very big way that we have only seen pretty much, at least this year, we saw in late February before the huge drop, the 30% drop that we ended up seeing over the course of 2 weeks. And so I think Thursday really changed the game. And not only that, but Friday, when we had that volatile 600 point bounce just to open the market, that was a confirmation that, okay, it's not just to the downside, it's also to the upside. And when you have balancing volatility in this marketplace, it is the exact same thing that you saw in early March, late February, where that when the market will go down 1,500, 1,400, it'll go up 600, 700, and that balance of volatility weighed into the fact that the overall market ended up teetering down, and it was actually a sign that there was a lot of fragility in the market. So this week, it's really tough to say whether or not the market's going to go up or down, because after Thursday, I think we're in a little bit of a new environment in terms of volatility. Not to say that we weren't already in a volatile environment, because I think we all knew we probably were in some state of that, but it's definitely been heightened. And so this week, I really expect it to increase. We are still low in terms of relative volatility to what we saw in the late February, early March. And not only that, but we're also seeing the COVID-19, I don't really know what the main headline was for the drop on Thursday. I believe it was just COVID stuff, but honestly, it doesn't really matter. They could make up whatever headline they want and try to explain the drop. But I think that headline will be very important going forward based on some of the data that we're seeing coming out on Texas and Arizona and Florida. I could definitely see the market using this as a catalyst to take more profit. Exactly like Austin said, this market is still overbought after this historic rally that we've seen. So we definitely need to work off some of those conditions. And, I came in to last week thinking that there could still be some winners, even if the market was going to be dominated by a resurgence of COVID cases. I thought, the usual winners, the gaming stocks, the Walmarts, the work at home players would be safe. But technically, based on what I saw, even they look susceptible to another downturn. So I thought it would be more of a secular pullback, but it's looking like that's not the case, and it could be a broad market pullback all around. So that's kind of what I'm expecting going into this week.
Yeah. To add on to that, I think last week we spoke about, I think you were thinking that we might have secular market sell-offs, and then certain sectors might actually perform better while there is, some maybe distribution or rotations in the market. But I think you're absolutely right. It just doesn't seem like that was the case going into Wednesday through Friday. It seemed like everything was selling off. Even a position that I was in, Beyond Meat, I figured that Beyond Meat was probably going to capitalize in this kind of situation where, okay, if there is a broad market sell-off, it had this whole China partnership news. It also, could capitalize on the fact that meat factories are not doing so well. But even that got sold off. The entire rally that it had of 20%, all of that pretty much got retraced. So I'm kind of in agreement with you where it seemed like everything got sold off, and it doesn't matter what the news catalyst was, because we spoke about last week how positive catalyst would be the one sign where we could understand if there is more of a sell-off to come, where if there is a positive catalyst and then you start seeing a sell-off, maybe that might be the area to take profit. And I think a good week or two ago, we saw, the positive job numbers, even though they're kind of riddled with some errors, we saw that. And then obviously this whole hopium of, retail traders aggressively net long, that could have been the catalyst to the negative side. And then on top of that, the coronavirus cases, as you've mentioned, increasing in Texas, Arizona, the Carolinas, Florida, and California. So it's just, yeah, you're right. I think it's hard to pinpoint exactly what caused the market sell-off, but it could also be all of those things together.
Yeah, no, I totally agree with that. I just think as far as trying to play out the winners and losers, because it does make sense, like for you to buy a stock like Amazon, if you think that people are going to be staying at home more and shopping online more, like their estimates are still very much in line with that theory, and it should make them grow this year, next year, and beyond. But I just want to say that everything should pull back initially. But as of now, you have to look at the stocks that were holding up before, like the gaming stocks, the Walmarts and Targets, as the stocks you need to buy once the market gives you that first bottoming signal. Because I think it's kind of like what happened in February. Walmart did end up tanking. I think it was like at 120 and it went all the way down to 104 or something. But even as the market was down, still down, I think 25%, Walmart actually started trading up close to its highs and it started spiking up. So yeah, even though there's this pullback now, be ready to buy those winners that were showing you they were strong beforehand. That's all I got to say about that.
Fair point. Austin, anything to add on that?
I look at the market a little bit differently, and I don't pay a whole lot of attention to day-to-day or week-to-week fluctuation. I always say, keep your focus is to what I believe that long-term, a year from now, the market is going to be much, much higher. And primarily because there is absolutely no substitute for all this unprecedented liquidity that is out there. And unless there is a total disaster on the virus side, my feeling is that the stocks that you want to own, you just let these have a price point in your mind, and when they come in, no matter what the market is doing, you keep adding to those positions. I truly believe that we are as a cusp of just an unbelievable run in the market over the next few years or so. The elements are there, and I'm not a permanent bull. I'm not always, 100% in type of guy, but I really see the ingredients for a very, very positive market. I think that some of the innovative technology stocks will continue to be the stocks that you want to own. 5G is going to play a huge role next year, and it's going to change a lot of things as we see today. Literally, a lot of hardware that we use, the phones that we use, they're going to have to be replaced. The PCs and whatever have you, a lot of that stuff will go through a replacement cycle, which is a huge opportunity for tech companies. So I remain, positive. My strategy is I want to own certain companies, and when these stocks come into my buy price, I'm going to add to it. I personally care less what the market does. Short term, I truly believe there's going to be a bumpy ride, but it will slowly and eventually grind higher.
Austin, can you explain some of the catalysts that you're talking about? You stated that you see all the ingredients, possibly ready to push the market up higher. Can you talk about those individually so our viewers understand?
Well, first of all, you have unbelievable liquidity in the market, and Fed is telling you that they're in no rush whatsoever to take their foot off the pedal. Secondly, what that means is that they're going to make sure that the rates remain quite low for the foreseeable future. And I do not see any signs that we will see inflation anytime over the next 2-3 years. So when you combine all this, and as the analysts ratchet down their earning estimates for this year and next year, the companies will have a unbelievable potential. Good companies will have unbelievable potential to beat those numbers. So I think in this environment, you will see, as the earnings stabilize, as we get into a little bit of normal environment, the estimates will start to go up, and the multiple will explode on the upside.
And you don't think that, to talk about a broader point, you don't think in any way that we're in a either in a large asset bubble or we're in the creation of one?
If you follow my tweets, I sent out a tweet last week. I said, if we have all the ingredients to have a super duper bubble down the road.
Oh, wow.
And this liquidity, this situation is going to create. So as an investor, you ride those bubbles. Yeah. And if you're smart enough, you should be able to get out of those bubbles in time. And that's where you make real wealth. These bubbles come about once in a while, every 20 years or so. And I think now we have the ingredients, for at least equity market to go through this super bubble.
So the one thing that I talk about with our members, and I think Faisal and I have discussed this too, is what you see nowadays is this almost childlike mentality of people who keep talking about, stocks only go up. You could also see, the put to call ratio at its, lowest point. You could see calls are being aggressively bought in the option side on even, more larger speculative and overextended companies like Hertz or American Airlines, or I think it's like Macy's, JCPenney, or Nikola, all these different companies. Do you not think that we're already in that bubble and maybe we might be at the top of it given the kind of over exuberance in the environment?
I've seen bubbles before, and this is no bubble. One thing I'm going to tell you that it's very important. People that have seen these cycles before 2-3 times, our experience is quite different. And so all this noise about, the new Robinhood traders coming in and driving this market, it's all noise.
Interesting.
Uh,
Faisal, what is your opinion on that?
I think you can classify things as a bubble. It doesn't have to be you think the whole market is a bubble or not. There are definitely some sectors that are in some type of short-term bubble, especially because of how the risks are. The risks are so uncertain in the hospitality industry, the airline industry, in some segments of the banking industry, the energy industry. Yet we are defying those realities at this point. So I think there is a case to be made that there could be a bubble. Do I think that it could end up coming to fruition if there's a V-shaped recovery, or I'm sorry, end up balancing out if there's a V-shaped recovery? Sure. Travel could go back and these businesses could end up surviving if things return back to normal very quickly. But I don't know. Like, I think more time has to elapse for it to be really confirmed as a bubble. But at this point, just when you see small characteristics like Hertz going up so much after its bankruptcy and saying it's going to sell $1 billion worth of the stock, I think that is indicative of bubble characteristics, but it's not indicative of the entire throwing away the entire market and saying it's in a bubble. I think you just have to say certain sectors and industries are currently in a bubble, which, I mean, as of right now are pretty much the hospitality industry, the airline industry, and other segments of the bailout area. They just have way too much risk for their premiums right now.
Yeah,
let me add one thing that in 2008, during the tech bubble, what we saw was that companies that had absolutely the ultimate potential of growing their businesses, maybe 10 to 15%, were trading in hundreds of multiple. That was a bubble. Now these tech companies that you see today, there are absolutely no way you can classify them as bubbles. These companies are making money, growing the top line and growing their bottom line, and they're still trading 10 to 15 times their sales. So when that number goes up to 60 times the sales, then you know that you're getting into that trouble zone. I don't see it here.
Got it. Okay.
I just want to touch on that a little bit. So I agree with you totally on the software valuation as far as they should be trading with their historic growth rates, because you've never seen software companies really grow this fast and have this much market adoption for multiple levels of software. And I think the numbers came out, I think Friday, from a Jefferies report saying that still only 10% of businesses are mass using cloud adoption rate. And they're expecting by 2030, there should be around 50% that have adopted a multitude of cloud-based products. So that 3030 is 10 years from now, and that's a 40% jump. So I totally get you. These stocks, even though they're trading at very high valuations, you look at stocks like ServiceNow, Coupa is 100 and trading at 200 PE. Yeah, it's very high, but those growth rates and their technological avenues do justify that. But I just really can't ignore the fact that in some segments, like I said, in the airlines or the bailout sectors, there's just too much positivity. And I think, I don't know, I mean, I wasn't around to trade during the last bubble, but obviously it was dominated by the housing and financial crisis, so those stocks went down the most. But at this stage, I think we could see another leg down, even lower than what we saw in March. It may not be in the broad market, but it definitely could be in those highly inflated stocks like the airlines and the Hertz of the world. I just want to give a little bit touch on that.
We totally agree with that. I think you saw tremendous short covering in these sectors because they were literally written off as companies that are going to go bankrupt. And investors were thinking that airlines will be owned by the government because they have no way of surviving this. And it still might be the case because, unless things come back really quickly, their financials look awful. Same thing goes with the cruise lines, same thing goes with hotels, So a lot of these sectors are definitely speculative to me, but they're not, I wouldn't call them bubbles.
Got it. Yeah, and to add to that, it almost seems, so I think I had just essentially started, watching the market and started trading in 2008, 2009. I was just trying to understand the feel of what was going on. And from what I can understand, there was definitely heightened fear in that market. And right now we have something, completely conversely opposite to what we saw in 2008, 2009, which is over exuberance in the market, while the overall economy, the underlying economy, as well as, the coronavirus epidemic is still very relevant. It's like we have the dichotomy of thought of, okay, well, we're improving, but yet the stock market has aggressively outpaced any improvement in the underlying economy. And I think a lot of the questions that most people have right now is, how is it possible that the market just kept going up and up? And, even now, people are still saying that it can go higher. I think the moral justification for that is not there. The maybe even financial justification for that doesn't seem like it's there. So I guess, Austin, if you were to answer someone, who's looking at this market as, well, I'm too scared to buy in because it seems like I might be buying the top, what is your piece of advice that you would give to these people?
Remember that people that move these markets are not people like you and me. They are very sophisticated investors that have the ability to look 2 years down the road. And what you saw in this market was not just it actually, prior to coronavirus thing, the market had a very narrow leadership. It was a handful of stocks that were driving the market higher. But in this uptrend, what impressed me the most was how much broadened this market has become. So many sectors, all of a sudden we were seeing stocks that are starting to break out, So what that tells me is there's some serious investors that are looking at this market and looking at the numbers 2 years down the road, and they're taking positions. So to me, the advice I will tell you is, again, a lot of this is noise. The fundamental ingredients are still there for this market to be much, much higher a year from now or 2 years from now. You're not trading the market, you're trading stocks. So make a list of the stocks that you want to own, and when they come into your price range, do your homework, figure out where you want to own this stock, and when they do come in, have the courage to buy them, because they never ring the bell to let you know that it's safe to get in. So my advice is that says, it takes courage to be an investor. And that's what it takes in a market like this when there's so much volatility.
That's a great point. And to expand on your point of, the people that really move the market are not investors like myself or you. These are big players who have larger time horizons, larger ways of looking at the market that you and I may not have the kind of data to back up. Now, going along with that, I had posted something on my Twitter, which was, about Ray Dalio's hedge fund, Bridgewater Associates, is down about 20%. Warren Buffett sold airline stocks and is largely in cash. Jim Simons' hedge fund, Renaissance Technologies, is down negative 20%. How do you make sense of all this when some of the most prominent figures in the world, in the hedge fund world, institutional world, are actually down on their portfolios, or largely in cash, or looking at going into bonds? how do you square off what's happening in the market to how they are positioned?
Well, they're basically these guys are very smart, but they're after all human beings, and they miscalculated. But there's a pool of smart money out there that we never hear about. They never ever talk about their positions, but they're very smart people, and they're the one that were on the right side of the market this time around. Some of these guys just missed the market, but trust me, they'll be back on track again, and so you can't write them off.
Yeah, fair point. The last thing I want to discuss is, and again, we're going to have another separate discussion for the Advantage members, the paying members. So they will get to know the positioning that myself, Austin, and Faisal have in the market, and how we're looking at the market for the week ahead. But if you guys are interested on the free side who are watching, make sure you hit the thumbs up or join our membership. But now going on to the dollar, okay. Last week, we saw the dollar yet again, spike up in an almost similar manner like it did, around that March time. Any concerns about that, Faisal?
It could be a multitude of factors at this stage. I think when you saw that spike up in March, it was kind of like everyone just getting out of everything and going directly into cash, and the dollar was seen as such a safety trade back then. But the factors influencing it now could be something more that could create a little bit more longevity in terms of a decelerating dollar maybe in the long run, but actually, once again, if we see an uptick in COVID-19 cases and everything like that, which we're seeing now, yes, that could reflect exactly what we saw in March. Though I don't know, because there's not this global fallout that I think will happen like we saw last time. So while we will see a spike in the dollar as a result of cases rising around the world, and the dollar once again becomes a safety trade, I don't expect it to get as high as it was before, basically because of how much we're pumping money into the system compared to every other country, and the fact that China is actually expected to grow this year. And I think that will end up causing some weakness in the dollar and ultimately maybe bring down the dollar a bit for the next 2 years or so. So I think China's growth will be something to pay attention to relative to the dollar strength, maybe in a 1 to 2 year time frame. Because the numbers coming out of China and their recovery are very, very interesting. They're spending a lot on infrastructure. They're increasing a lot of their home front economic factors. And I think that will end up causing them to be one of the only economies to grow this year. So I would just say keep an eye out for that. But as far as this move, yeah, it's looking a little bit like what we saw in March. And it's really strange that it's kind of pairing up with the rising COVID cases.
That's an interesting point that you make about China, Faisal, because the recent news in China was they actually found, I think, 40 to 60 more cases, and they shut down one of the largest markets in Beijing. And this just came out, I think, yesterday.
Oh, really? Oh, damn.
Yeah. So I think the news just broke out yesterday. And to add on to that, with America sort of going through this whole, printer never stops printing kind of process, living in South America, the one thing that I've learned here is that other economies are struggling much worse. So we have some friends in New Zealand, South Africa. We have some, in Asia, like Bangladesh, Philippines. And I think a lot of them are kind of saying that, yes, life seems to be somewhat back to normal, but businesses are not picking up in the same stride as it was pre-COVID, because I think the behavioral aspects of life have kind of changed. Even living in Colombia, we have some of the lowest cases in all of South America. Yet when I go to restaurants, coffee shops, walk into the grocery store, the capacity that I saw pre-COVID is almost down, at least 60 to 70%. And I can't imagine America, going through what it's going through right now and have the same kind of capacity. And so with that, my point is, I can't see a world where the dollar doesn't spike up again, especially against emerging markets, especially given the fact that we're now seeing coronavirus cases rise. Obviously, I don't know if the Trump administration is going to want to shut down the economy again, but I don't really see a world where the dollar doesn't go back into the 100 or 103 range, because we have so much in front of us in terms of the angst in the political system that's happening, the angst in the economy, coronavirus. So I guess I'll ask a question to Austin is, Austin, do you sort of bring any relevance to the dollar? If so, like, what is your projection of the next 3 to 6 months of how you see the world shaping out?
It's interesting. You were talking about people's habits changing, and people not, you don't see that many people in grocery stores or in restaurant. But I went to Home Depot last Sunday, and it was unbelievably crowded. So it is amazing that if people are not spending money on eating out or doing other activities, they have found a way to spend their money. So they are at home fixing things in the home. So American consumers are just unbelievable in a sense. That they are the backbone of the global growth. They find a way to spend their money.
Yeah, that's a great point.
So you never count them out. They will find a way. If they're not spending their money traveling, they're spending money fixing their home or doing something. So I on the dollar side, I just continue to think the dollar will remain in a range. It is very important for the dollar to remain in a range. Otherwise, the global economies are in big trouble, because majority of the countries have their debt in dollars, and these crises are going to get worse for the emerging economies. There's absolutely no doubt. They don't have the ability to print money like us in the U.S. So my concern is, like Faisal was saying, keep an eye on China. China growth is very crucial at this stage. That will pull everybody out. So I think that key thing to pay attention to here is progress that China is making.
The interesting thing about China from 2008 versus now is that in 2008, 2009, they actually went into a heavy stimulus program. Not only did they go into buying up their own products, but they actually came into America and started importing products heavily during that time. So in a sense, it was kind of China that really helped us get out of a tough bind. Obviously, other than our own stimulus packages, China had a big part and a big play in that. Contrary to this year, however, China actually has not gone through any large stimulus packages. So I'm really surprised that, they haven't quite made a decision to go into their stimulus program, kind of like the U.S. did. What do you make of that, Austin?
Yeah, I've been hearing some talks of Chinese government gearing up for a major stimulus program. So I think we'll see it in short term.
Interesting.
I think their top priority right now is to make sure that virus is under control, and it won't be long before they. I agree that they'll have to spend some money and get their growth back, get started again.
Yeah, fair point. For our viewers who are watching, just as like a disclaimer, we don't provide financial advice. And one thing, if you've been watching us for a while, I would probably say Austin, as our guest, is truly much more bullish than myself or Faisal. I would say Faisal is much more neutral. I'm definitely a little bit more bearish. I think I have a more cynical view on the world, but I feel like sometimes you need, that the cynics to kind of like hold you or pull you back down to earth when you see like the world falling apart. But then I also need people like Faisal or Austin to tell me like, hey, the world may not end tomorrow. Everything will be all right.
Yeah.
So
I just wanted to touch on a little bit about the stimulus that China is doing. So I've been reading a lot of reports and stuff, and it's most likely going to be going into infrastructure. That is where the country is looking to shore up all of its job loss and hopefully create a lot of new jobs through a massive infrastructure plan. And just to give you guys a little tidbit, I just would prefer, at least from now on my own level, I'm going to be watching materials like copper. And I think copper is a very big indicator of growth in China. So I would just pay attention to that based on the narrative that we're talking about now. If you wanted to understand at an even more in-depth level, if copper starts to break out in a big way, I think that's very indicative of the fact that China is trying to shore up its either its job growth or its economic growth in some big fashion.
That's a really interesting point about copper. I actually have not paid attention much to copper, but I do know that there are African countries who have big copper mining operations, or what are some other metals that China is mining through other countries? I think Zambia mines. I'll have to get back on that, but I think China has a big mining facility for certain metals or resources in many African countries. So it's really interesting that you talk about the industrial development, because the whole Belt Road Initiative, what China is doing to expand their reach in other Asian countries, all the way into Europe to expand its distribution routes, and then also helping out African countries and even countries like Sri Lanka. It just goes to show that China is not a country that's backing down, and they have this 50-year, 100-year vision of whether they want to take over the world or be the more dominant force. It seems like they're doing all the right things.
Yeah, from a material standpoint, I think you could definitely say that they are a huge consumer of materials and raw metals and stuff. And so they've made very strategic inroads into Africa, trying to achieve their goals, exactly what you said, their 50-year, 100-year timeline. And yeah, we are still in the early mid stages as to what they plan on doing and how they plan on achieving that growth cycle. So yeah, I totally agree with you.
So last point I want to discuss before we have, the private discussion about our positions is, we were talking about this a little bit earlier, and this is, again, every time I feel a little bit more bearish in the market, I put on, the Big Short movie with Christian Bale and Steve Carell, and I like to watch that because it helps you kind of understand what was going through people's mind, because a lot of America was kind of clueless. I think there was so much hope and optimism, kind of like it seems like there is right now, where people don't really see the next leg coming, where millions of people lose their jobs, pensions, companies shut down. It almost seems like the same calm before the storm is happening right now. And to dive into the specifics, we were talking about CDOs and CLOs before the call. So for our viewers who are watching, CDOs were collateralized debt obligations, which were more housing and mortgage related in 2000 and 2009. That's where you started to hear the words about mortgage-backed securities and all these, tranches of loans that were, filled and packaged up into these big banks. And when the American consumer, American homeowner started to default on those loans, that got onto the bank balance sheets, and obviously you started to see companies or banks like Bear Stearns fail. Fast forward 10 years, till today, we have something similar in terms of an instrument. We call it the CLOs, which are collateralized loan obligations. these are specifically related to the over-leveraged companies that require more financing. Maybe they need to, I don't know, pay off their loans or seek expansion. They can't do that by raising money through bonds. They can't do that whether it's with their shareholders. So they get into these CLO programs. And the one thing that I found out was some of the biggest CLO holders right now are two big banks in America, which are JP Morgan Chase and Wells Fargo. JP Morgan Chase has about $24 billion in CLOs, and Wells Fargo has about $30 billion in CLOs. And by the end of the year, Wells Fargo is supposed to get up to $38 billion in CLOs. Now, all these things come onto the bank balance sheets, and the way this could go bad, kind of like 2008, 2009, is when you start seeing more and more companies failing, right? So similar to what happened with smaller banks and maybe companies and the real estate market kind of falling apart, what we might start seeing is the corporate side of companies that are zombie companies right now falling apart, and then these banks are going to be held responsible, for that debt onto their balance sheet. Any specifics? I'd like to turn this question over to Austin. Any specifics on this kind of information, and does this concern you?
As long as you have Fed basically saying they'll do whatever it takes, and frankly speaking, the bank's balance sheets and also the management of the banks, major banks, is a whole lot different now than it was then. And these are totally different banks. They're much more smarter. They learned what the mistakes that they made. So I really don't make much of it. I think this is a unique situation, and the government is basically going to write a blank check, to save majority of the companies. So I'm not that concerned. I think the banks are in good shape.
Got it.
Trust me, I lived through that period during financial crisis, and it was like these banks had no idea what they were doing. The biggest problem with these banks was not the mortgage obligations they had, but what do they call them? They were basically selling insurance on each other.
Interesting.
And when one bank went belly up, when Bear Stearns went belly up, literally these guys had billions and billions of dollars of obligations that all banks got caught with. That was totally unexpected. That got them in trouble more than actually the mortgage obligation side, the real estate side.
Got it. So to end our discussion on the last point, I think the last week or two, I saw a lot of insider trades of CEOs and big management sort of letting go of their positions. Faisal, did you see information like that out there? And is that something that you kind of pay attention to or worry about?
Which CEOs were letting go of? Are you talking about like the bank CEOs?
I forget exactly which companies there were. I retweeted it on my Twitter, so I can't find it right now. But
if you're trying to value, I mean, insider selling, sure, you can value it, especially if there's an anomaly in terms of not only the time, because a lot of time insider selling is done on a pretty timely basis. It's usually planned out. Unless you get a very strong influx of multiple insider selling around the same time level. Like I've seen it plenty of times where if a stock has a really good run up, you'll see a bunch of insiders take profit because obviously they may think that the stock is a little bit too high. Then that would be a cause for worry. But most of the time, insider selling is usually done on a timely manner and shouldn't be taken as a negative.
Okay, fair point. Awesome. Any last points you guys want to discuss? And then we'll finally just have a private, call with our Advantage members and we'll discuss the positioning. Any last points, Faisal?
Just be ready for volatility. Like I think if you like the days of going up 200, 300, 400 points, I don't think they're here anymore. It's going to be the days of going up 600 to 800 to maybe 1,000 points, or going down 1,000 points. I think be ready for volatility. If you're someone who does not like volatility, loosen up your exposure to the equity markets, because it's really going to be a wild ride. So just be prepared for that.
Perfect. All right. On that note, I'll let the free viewers go. Thank you guys so much for watching. We're going to have a private session. Again, if you are interested, come join the Advantage side. We have a discount, 50% off if you're interested. Hit the thumbs up, and I'll catch up with y'all next Sunday. So let's have a private session now.